less ambitious than they once were. There is a risk of that. I would still say that, a 25 to 50 bip hike is not going to exacerbate that risk to, to a great degree. And I think always it's better to raise rates slowly. So I think the RBI is starting ahead of time, like you said, before everybody else, but maybe it'll have to go more slowly because
so more calibrated is possibly going to be the answer. We head into a short break, but when we come back, we look at whether the banking system is really geared up to see a hardening of rates. What happens to credit offtake if rates were to go up even by 100 basis points through the course of 2010, and what does it really mean for the domestic consumption story? Stay tuned. Welcome back. You're watching In Focus, and In Focus is a question on the rates and whether we could see the beginning of a serious hardening starting this review time on the 29th of January. Of course, Bloomberg UTVi spoke to India's top bankers to get a sense of what the signals were on the ground, and this is what they had to tell us.
At this point of time, if some pressure is put by way of withdrawal of liquidity or increase in the interest rates, this recovery or this increase in both GDP and credit offtake, which at the moment, at least I am not very clear whether it is sustainable or at what rate it will continue to go in the future, it might be hurt.
I think it's important that the stimulus package continues, because we are just beginning to see industry come through in terms of its own performance, and to yank it too soon can create its own issues.
If you look at the secured retail lending like home loans and car loans, the portfolio for most banks has been performing very well, and the loss levels have been very stable even during the most difficult times in the economy.
Q4 could be a strong credit growth, but for the full year 9-10, the credit growth could be in the range of around, let's say, 15 to 16% as against the earlier guidance of around 18%.
Well, those are bankers talking about how the signals are on the ground, and the worry was pretty palpable. I'd say if you heard O.P. Bhatt, Naina, all of them talking, saying that we're seeing the first signs of recovery, don't harden or tighten at this point. But can the RBI afford not to tighten at this point?
I really think that every central bank is looking not at the current, either trends in credit growth or inflation, but they're looking ahead 12 months from now. And that, there's a problem with trying to predict that there's a 50% probability you'd be wrong. But all the signs point to inflation, that is non-food inflation, actually rising. So we know that, okay, non-food inflation right now is not a problem. 12 months from now, when recovery is fully underway, as we hope it will be, non-food inflation will start to rise. So that is something I think the RBI is looking at. Secondly, again, credit growth. Right now, 15% is the estimate for the year that's just ended. Next year, I'm sure credit growth will be in the 20 to 25% range.
How are you saying that, Atsi? Where do you see the credit growth coming up? Because, you could argue that on the ground, we've seen credit growth just about picking up in the month of December.
Right.
But look at the cues that we're going in with. You're going to see possibly a very tight liquidity situation because the government's borrowing program will come through. And then, of course, if rates are hardening, there are not going to be those many avenues. And many banks have reached upper circuit as far as, core areas to invest in or lend to are concerned.
Sure, but if you look at, go through the earnings season and look at corporates, there are some, particularly sectors in infrastructure, power, etc., even construction, I would imagine, where circuits have been raised. But there's a whole other segment where actually credit growth has not picked up. And I think that's where you'll see it picking up. For instance, in the quarter that just ended and the quarter prior, you saw that, margins were expanded because people were actually using earnings. How did you see IIP growth at, 10, 11, 12% without credit growth, credit growth at 10%? That seems like an anomaly. What were companies doing? They were using retained earnings to fuel their growth. They can't keep doing that forever.
Or tapping the stock markets.
Or tapping the stock
market. Which might
market.
not be an avenue this time around. Larson's results this week were a bit of a scare, if I can use that term, because really it indicated that all might not be really well in that core infrastructure spending side that we were all hoping for.
Very true, very true. If you really go through and read the numbers little bit in detail, it really is a worrisome signal. It basically talks about that though the order book looks healthy, but the orders are not really getting closed up or getting converted into actual orders. Extend the same logic and go back a little bit in history. There's this whole per capita income riddle also, which is very important. In last decade, India started from $500 and we are around about $1,000. Let's see China, Malaysia and other countries. When they moved from $1,000 to $2,000 to $3,000, what's happened to their GDP growth? we are almost on the tip of it. I'm a big fan of consumption. I'm saying country like India with such a large population which is young, consumption is going to lead us. At any point of time, government, all of us together should try and promote it rather than nip it.
Is consumption, the ball of consumption already rolling at sea? And one argument is that rates really don't matter at the end. I mean, the aspirations of India are so much that consumption is a no-brainer from here.
I would tend to agree that, the aspiration aspect especially, and look at the signs that we have. The auto sector, which in most parts of the world is a good harbinger of overall consumption, it's been doing brilliantly. But it's also been doing brilliantly because auto prices were brought down over the last year. Excise duty cuts helped. Your lending, retail lending also improved for the auto sector. So you had all these good things happening, which certainly helped consumption, go. In the future, if you look at now, would, like you said, a rate hike make people who were thinking, well, I'm going to get a new car or a new scooter or whatever, think twice about it? I think it would really depend on, is my loan rate going to rise a lot or maybe just a little bit? And will my income rise a little bit more than that? So I do think that, yes, the signs are that there was all these stimulus measures that helped consumption in the past. Over the next 12 months, it has to be investment and pay hikes and sort of your income's outlook, not just help from the government, but sort of a self-sustaining rate of growth in the economy that helps us consumption go forward.
Will banks pull back from consumer credit as the tightening of rates and liquidity come in?
I think just given the under-penetration, even though consumer credit has been growing so fast and furious over the last 4 or 5 years, India is considered an under-penetrated market in terms of consumer credit. So I don't think a financial institution can afford to let market share go. So they'll probably go to areas where they have not been making loans before geographically. Over the long term, you have to be there as a bank.
Right. Well, we head into a short break. Coming up, a discussion on home loan rates and what a tightening could really mean if you have taken a long tenor home loan and you're worried about what happens 2 years down the line. Stay tuned. Welcome back. You're watching In Focus, and In Focus is a forthcoming monetary review, and the big question, could we see the beginning of a round of tightening? But before we move on, here's a look at why so many borrowers on the retail end are worried about rates and how a possible reversal could impact them.
For Anup Naidu, a telecom professional in Mumbai, this dream 3-bedroom home came at just the right price. Prices were depressed in the real estate market and his bank offered him a loan at a great rate, 8.25% for the first 2 years. Today, with the growth back on track, prices in the Mumbai suburb of Kharghar, where Anup lives, have started going up. And he isn't sure how high the rates will be after the next 2 years.
With the rates going up, obviously it will impact the EMI, which I don't know to what extent it goes, but it definitely gives a financial burden to my budget, my monthly budget. The more it goes, then financially I am in a soup.
But this isn't a dilemma that Anup faces alone. The 8% home loan rate scheme, started off by India's largest bank, the State Bank of India, set the ball rolling for a